welcome to today's NJCPA Business and Industry Professionals Forum. So this is a group where we get together every month and discuss issues that are relevant to CPAs who found themselves in business and industry or supporting folks in business and industry. So usually it's an open forum, but today we're going to focus on PPP loans. And originally it was just going to be one big Q&A session, but we thought, so we brought on our team of panelists here, and we thought there's going to be a lot of redundant questions. So we're going to start out with some frequently asked questions, so to speak, and then we'll go on to the Q&A. Use the chat box for any questions that you'd like to ask the panel, and I'll queue them up when we get to that point. Again, please mute your mics so that we can get through the FAQs uninterrupted, and we have plenty of room left over for questions. So today with us, in addition to myself, Chris Schiffer from Wealth Enhancement Group, we also have Karen Jessamine from CFO Solutions, Ken Bagner from Sobel & Company, and Srini Rao from M&T Bank. Srini works as a vice president and senior relationship manager at M&T Bank's business banking team in New Jersey. Srini is passionate about achieving financial success for his clients and invests a lot of time in learning about their needs and goals. He provides comprehensive business banking services for his clients in areas of business growth, expansion, and transition. And Srini has over 15 years of banking and financial services industry experience, and his education spans over 2 continents, which includes a bachelor's degree in science and mathematics from the University of Bombay and an MBA from finance from NYU Stern in New York. Also with us, Ken Bagner. He's the member of the firm and chair of the tax practice at Sobel & Company. He's the consulting partner on the firm's employee benefit plan audit group. Ken began his career at Sobel & Company in 1999. And over the years, he served diverse niches, including commercial real estate, waste management, manufacturing, construction, retail, wholesale, not-for-profit organizations, and employee benefit plans. In addition, Ken also devotes half of his time working with closely held business owners as their trusted consultant, providing insights and guidance to help them achieve their goals. And Ken is also an active member of the NJCPA. He served on the board of trustees for the scholarship fund and serves on the retirement fund committee and is a former member of the nominee committee. And he's a past member of the board of directors of the society. And also with us, Karen Jessamine. She's a CPA and MBA and is the owner of CFO Solutions, which provides outsourced interim, fractional, and project-based CFO services to small and mid-sized organizations. And she has assisted many clients with applications, compliance, and reporting for COVID relief funds, including PPP loans. Okay, so usually, before we start, usually when we run the Business Industry Forum meeting, we do some announcements, which I've already done. And then we do a roundtable of introductions. We do have over 50 people on the call. So we're going to skip over that part today. And then in place of that roundtable discussion, we're going to have like I said, we're going to have the PPP loan and forgiveness focus. So we're going to start with the FAQs and then go to the Q&A. So that said, let's start out with Srini.
Thank you, Chris, and good morning, everybody. So like Chris said, I'm Srini Rao with M&T Bank, and I'm here to talk about the bank's perspective with the PPP loan forgiveness portion of things. So going back when Congress initially authorized the PPP program through the CARES Act, there were more questions than there were answers. But then as we moved along, we learned a lot. And now that the program is well underway into the loan forgiveness phase, there are still many questions though. And the good part here is that the loan forgiveness phase is less time sensitive than the application was. in part due to the PPP Flexibility Act that was signed on June 5th. So at M&T Bank, we had the privilege to assist over 35,000 of our business clients and distributed $7 billion in critical PPP funds, which impacted hundreds and thousands of their employees. And based on the information, we have learned a lot of information and a lot of questions that we received. So I wanted to share some of them for the benefit of this group. This information, however, should not be considered as a tax or legal advice, and such questions should be directed to your own advisor. So the loan forgiveness itself, where do you apply for it? And essentially the loan forgiveness should be applied to the bank that originated the PPP loan. At M&T Bank, we highly recommend our borrowers to apply for the loan forgiveness, and they should not only get accustomed to the requirements, but they also should gather all the necessary documentation and the SBA worksheets before they get ready to apply for it. And we also advise them to work in close conjunction with your tax advisor. The bank right now has opened up our portal for accepting online applications to all our business customers. And as such, the borrowers can apply anytime once the funds are exhausted or after the end of the covered period. However, there are some implications on how the principal and interest payments are calculated, which we will discuss a little bit later. So in terms of the application itself, here are some tips and tricks. We definitely, when you apply, there is a question always comes up about SBA PPP loan number and lender PPP loan number. For our M&T Bank customers, that information is readily available once they log in using either their web banking or the treasury management portal. And then we recommend that you get all your payroll documentation from your payroll provider before you apply. And also, it's highly recommended that the loan forgiveness applicant should be the same person who applied for the PPP loan. So next slide, Chris, thank you. So what do we need to know about the Flexibility Act that we discussed before? So it was signed into the law and it provided more time to use the funds towards the qualifying expenses to be counted towards loan forgiveness. So these are some of the highlights of the Flexibility Act. It lengthens the forgiveness covered period going from 8 weeks, which can be 58 days, to 24 weeks, but no later than December 31st. So the borrowers who receive the PPP funding prior to June 5th, they have an option to use the 8-week period. It also extends the PPP payment deferment from 6 months to 10 months. So the borrowers essentially can have up to 10 months from the end of the covered period to apply before the deferment period ends. Also, there has been a revision of the proportion of the payroll and non-payroll costs. Before it was 75-25, now it's been made to 60-40. There has been a provision to allow deferment or paying delay in payroll taxes through end of 2020. And this provision actually allows that payroll tax to be paid through half amount in 2021 and the remaining in 2022. There are some additional exemptions related to the loan forgiveness reduction based on the borrower's inability to rehire, either based on the reduction in business activity or just employees not able to turn up for work. And we will discuss that a little bit later on as well. And then the payroll cost itself is capped at $100,000 on annualized basis per employee. So for a covered period of 8 weeks, there's a maximum of $15,385 per individual. And for 24 weeks, it is a maximum of $46,154. Next slide, please. So when the SBA issued loan forgiveness applications and instructions on June 17th, there were 2 applications available, which were the 3508 Easy and 3508. Each was designed with a specific purpose. And then on October 8th, the third form, 3508S, was introduced for the PPP loans up to $50,000. However, this form cannot be used if the aggregate amount borrowed by the company and its affiliates is over $2 million. So they should be really using the 3508 Easy or 35-word forms. The borrowers will still need to supply all the necessary documentation for the loan forgiveness application, including the Schedule A. Although the Schedule A worksheet is not required to be submitted, that's just for the purposes of the calculation. And we will touch upon the loan documentation requirements slightly later on during the presentation. So as such, when you're completing the loan forgiveness calculations, before you apply, do get all your calculations in order. And then the information that you're going to use needs to be retained at least for 6 years. That's recommended. And any information that you provide on employees, the information that should include is the employee name, the last 4 digit of social security number, and the amount of the income that they received, just as an identifier for that particular employee. Next slide, please. So this is how the loan forgiveness will work. And these are all the eligible expenses, as we know, which are broadly divided between payroll and non-payroll expenses. And the payroll costs, the business and rent and lease agreements, business mortgage interest, and business utilities. So 60% minimum needs to be payroll expenses, which is related to health and benefits and payment of state and local taxes that are imposed on employee payroll. And then the remaining are really towards the business mortgage obligation, rent, and utilities. And these expenses essentially had to have be in effect before February 15th of this year. Next slide, Chris. So let's quickly touch upon what's the definition of independent contractors and what they can really do, like in terms of what they can expect in terms of getting when they apply for it. So independent contractors, self-employed individuals, and sole proprietors, the owner compensation, the compensation for 8-week period is capped at 8 1/52 of the 2019 net profits, or 15,385 per business, whichever is less. And also for over the 24-week period, if they choose to use that, then it's 2.5 months worth of 2019 net profit up to the amount of 20,833 per business. This does not include the qualified sick leave that was credited as part of the Families First Corona Response Act. And the business owners with employees can have payroll and non-payroll expenses for the employees themselves, but not for the owners, unless the owners are also W-2 salaried employees. So when you do apply for the payroll expenses, provide the form 1040 Schedule C, which shows the profitability. And then the borrowers that don't have the employees can then just use the eligibility on the basis of the factors that we discussed earlier. And for the non-payroll expenses, the health and retirement plan contributions are not included. However, employees with W-2 can include health and retirement benefits. Next slide, please.
Hey, Sri.
Yes,
The last slide said, just for confusion, just to make sure there's no confusion here, on the top it says owner employees defined as having greater than or equal to 20% ownership in the business. That was on the application. I believe the SBA's Q&A says 5% now for partnerships and C corps and owner employees. That's how they define it, just to be clear when people are filling out the application.
Again, thanks for that added color on it, because that definitely is an important factor that was added to later on. So speaking of which, let's look into some important considerations to know about the loan forgiveness. We already covered what the loan forgiveness covered period was earlier as part of the Flexibility Act. There is also an alternate payroll covered period that typically defines that the period begins right after the first payroll cycle that starts and during the covered period. So in other words, the regular covered period basically starts from the day the loan was disbursed, whereas the borrowers have an option to use the alternate covered period, which essentially starts on the first payroll cycle. Now, several borrowers have had challenges in hiring their employees back and to get fully staffed, especially when they are calculating the FTE requirements. So there are certain exemptions that are available, which are being highlighted here. So as far as they apply by December 31st, there are two options essentially to cure that issue about having less employees. So in scenario one, where the borrower was unable to hire employees that were hired or employed with them prior to February 15, 2020, and then the borrower was unable to hire similarly qualified employees for those unfulfilled positions prior to applying for the loan forgiveness. And then the second scenario is more straightforward. The borrower was unable to return to the same level of business activity as prior to February 15, 2020, due to the compliance with federal or state requirements as per the guidance related to sanitation, social distancing, or other safety requirements of COVID-19. So as such, the borrowers have until December 31st, 2020 to restore their full-time equivalency and the salaries and wages.
Shri, just to add on this, if you don't mind, this is safe harbor when you fail your full-time equivalents. When you start looking at the options, there's two options. There's option 2 look-back periods, and there's 2 options to look at on full-time equivalents that payroll report should run. What you can do before you fail the safe harbor and go into the safe harbor is reduce your full-time equivalents by termed employees that actually were terminated with cause, or people who voluntarily have resigned. You have to keep that files on hand. You don't have to submit it to the bank. But before you even go into the safe harbor, if you're just like losing the forgiveness by like 10% and you terminated an employee with cause and reason, you could reduce that out of the FTE count.
Yeah. Thank you, Ken. There are also FTE reduction exceptions where the borrower can exclude any reduction in FTE as far as it has been done in good faith. So borrower made a good faith written offer to rehire during the covered period. The offer was pretty much made at the same salary and wages and the same hours, and the employee essentially rejected the offer. So for all this, the borrower has to retain the records that the offer was made and rejected, and the borrower is also obligated to notify the state unemployment insurance office about the employee rejecting the offer within 30 days of happening. Next slide, please. So what information is needed before you apply for the loan forgiveness? And it's, as I said before, it's important to be prepared and have all the information, and basically at a high level, the payroll and non-payroll expenses are the high level classifications. So under payroll expenses, some of the common supporting documents that we see is the bank account statements or third-party payroll provider reports, which basically documents the cash compensation paid to the employees, any tax forms or third-party payroll provider reports, such as the payroll tax filings and state quarterly wage reporting and unemployment insurance tax filings, any receipts, canceled checks, or account statements that document the group insurance related to employee, as well as the contributions made for the retirement plan for the employee as well. So the FTE documentation essentially, as we stated before, includes any job offers made, any refusals, any firings that happened because of a cause, or people just resigning. Again, these are the documentation that are required to support how they arrived at the FTE employees. As regards to the non-payroll expenses, typically the business mortgage interest payments, they can either come through in the form of amortization schedule or cancel checks, or even bank statements starting from February 2020 for each month during the covered period. As regards to the business rent and lease payments, a copy of a current lease agreement, as well as the receipts and the copies of the canceled checks or the bank statements, again for the same period, starting from February 2020, and for each of the months during covered period, plus an additional month. And if they're using the business utility payments, then again, the copies of the invoices from February 2020 on, and receipts of canceled checks or account statements. Next slide, please. So what if the PPP loan is not forgiven and they have to start paying on it? And so typically the terms on that is 1% APR spread over 24 months. If the time when they applied, if it was prior to December 31st, then the required payments of P&I will be deferred until M&T receives the forgivable loan of the from SBA. But then if they are applying after December 31st, then the P&I payments will be deferred 10 months past the last day of the covered period. The monthly P&I payments do get recalculated once the forgiveness has been determined, and the balance of the remaining is spread out over the term of the loan. There are, however, no prepayment penalties, and they can be paid back anytime the borrower wants to. Next slide. So that's pretty much from as far as the banking side is concerned, and I would like to now pass it on to Ken to discuss his part of the presentation.
Yeah, thanks, Shri. I have a top 10 list here, but overall, just talking before I even get into it, I'll talk about experiences that I've seen, because I have about 185 clients that applied for PPP. Some of the banks are accepting the applications. In fact, I had about 5 to 7 already forgiven by the SBA, which was kind of surprising. Right now, when the banks are submitting, from the date someone submits to forgiveness by the SBA for under $2 million loans, because Karen's going to talk about a little bit later, which I just conducted a seminar for our firm yesterday on over 2 million, and the questionnaires that Karen will be talking about at length, which is important for anyone on this call that's helping their clients with those applications. I've seen within a week and a half or so it going through some of the banks and then approved by the SBA. The banks have, that I've seen, this is an interesting thing. So some banks are saying you have to put in your non-payroll costs, even though those non-payroll costs are not needed to reach 100% forgiveness. A lot of other banks are saying you don't need to do that. And by the way, the SBA doesn't care. They're approving these with non-payroll costs. So if a bank is saying to you, you have to put the non-payroll costs in, you have to attach all the supporting documentation, you should go back and say to them, well, the SBA is approving these applications without the non-payroll costs, and it's just extra paperwork. And if you don't really need to do it, I'm seeing full approval. So I just want to point that out, and what I'm seeing in real time right now. It is potentially an issue to pull together all those documents, the contracts, all the statements, proof of payment. It's going to take time for anyone who's helping their clients pull that together. So if you could avoid doing that, it really simplifies the process. So a couple of things I wanted to talk about on a top 10 that I've seen. And also I will add the IRS's stance right now on PPP at the end. FTE methods, what we've done is payroll companies have done a wonderful job running reports like ADP, Paycheck, Ceridian. Those reports that they have, all your clients should be using. Some of them have been resistant, and I've said, you just use them. It's so much easier. It lists out basically 6 columns if you've seen these reports. The 2 columns are the look back periods for the first look back period, which is method 1 and 2. The first method that you could utilize is a method of taking everybody over 40 hours, they apply as 1. Anybody who has less than 40 hours, like 38 hours, you take 38 divided by 40 and you get a ratio. You add it all up and basically average out the look back period and you have a number. The other method is taking anybody less than 40 hours and treating them as 0.5. So you have look back period 1 that compares those 2 methods, look back period 2 in 2020, January to February, that compares those 2 methods. And then you have your covered period, which is either 8 weeks or 24 weeks. You look at so you have a choice basically of a matrix of 4 different choices to use, basically look back period 1, method 1, look back period 2, method 2, and so on and so forth. You'll find that what you need to do is take a look at the ratios to see what the best ratio is. And then you could reduce out your terminated employees with cause. You could reduce out, in addition, you could reduce out anyone who resigned from the organization. You just can't reduce out employees that you fired or laid off because of coronavirus. That's basically what you can do. And you don't have to submit any of that information to the bank. That information can be kept in-house. And once you reduce out that number, if you're low enough, you do not have to go to the safe harbor test. And you may even have to be able to use like an easy application because you have no reduction in maybe hourly wages or employee count. If you have to go to safe harbor, then you got to run a separate safe harbor test from the payroll company. So again, use your payroll company to really look at what you need to do. If someone has a question, are the pay dates between 2/12/19 and 6/30/19 or 1/1/20 and 2/29/20? Those are the look back periods. Generally, I think it might be a few days off on that question, but that's basically the two look back periods that you look at that I was talking about. So number one is make sure you run your payroll reports. Make sure you utilize ADP or Paychecks or Ceridian or any other sort of service. That the smaller services hopefully have these sort of reports. That's wonderful because it will really help to be able to do the calculations. On the second top 10 here is just if you cannot give your loan forgiven, especially some of these over $2 million, which Karen's going to be talking about, it's very concerning. Some of the questions they're asking about liquidity and some of the questions they're asking about Monday morning quarterbacking with your revenue, then you could still ask for potentially a 5-year payback with the bank, but you're going to have the bank change the terms because the terms were originally 2 years on most loans. They're going to be 5 years if you want 5 years, but you're going to have to ask for that paperwork and re-sign the paperwork to make the change. Chris, if you can move to the next slide. Okay, so there was a lot of questions that were coming up and on the owners and owner employees. General partners, basically you take your K1 from 2019, you have to reduce out your 179 and some other items, and you're maxed out 2833 period on a 24-week program. You cannot add anything else into it. For S Corp owners, you basically can take the 2833. You could add your retirement plan contributions, but that was limited to the week period of your normal contributions. So it'd be like 24 over 52. No health insurance if you're over a 2% owner. No health insurance for family members in the PPP Q&A for over a 2% owner. Someone has a question. I have a client that has got the loan in June, but he started payroll in October. I didn't get the rest of the question, Chris. It went off the screen, and maybe you could go back and read that later. We'll come back to the questions later. C Corp owners, there's a cap of the 2833, which is more than a 5% owner in a C Corp. That's how it's defined. Same thing with S Corp. It's defined as a 5% owner, but there's caps on 2% of health insurance, just to make the distinguishment. With C Corp, you can include your health insurance and employer retirement contributions above the 2833 amount, just to be very clear on that, plus the SUI and SDI for S Corp and C Corp owners. For partnerships, you cannot include any of that information. If you can move to the next slide, Chris. Related party rent and subleases. So I got somebody at the door. Beauties of working at home, right? So related party rent, if you are including non-payroll costs and you're including rent, if you actually have a client, if your client actually owns the building and the business and they're in separate entities, if they own the building and they're renting the building to the business, you're going to have an issue with related party rent. You cannot include the rent. You could only include the interest on the mortgage that the related party has. So doctor office, he operates his doctor practice. He owns the building. The building leases and they rent, the doctor practice rents from that entity, which is I'll call it Doctor Holdco Rent Company. That company, if they have no mortgage left, there's no deduction for rent that you can include in non-payroll costs. If they have a mortgage, you can include up to the interest expense. That's it. If they rent to multiple parties, then you could allocate it as well. You can include the full rent related to the people who are non-related, and then you have to allocate the interest portion related to the mortgage interest if there's mortgage interest on the property. So that's a little bit tricky. If you are including non-payroll, hopefully a lot of your clients with 24 weeks do not need the non-payroll costs, and it becomes a little bit tricky to put all that information in. Mergers and acquisitions, which is number 5. If any of your clients are buying a business or they're selling their business, there's rules now that came out about 3 weeks ago with 20% change in ownership for stock or 50% with assets. You're going to have escrows put away for the PPP. You have to notify the SBA, or you have to pay off the loan basically before the deal goes through. So got to be very, very careful to talk to clients that are having a potential transaction to make sure that that's done in the right way. Chris, if you can move to the next slide. Bank requirements. Banks may require a borrower to use non-payroll costs. We talked about that. I would fight that at all costs if you don't need to do it, because I think it's a waste of time and it's a waste of a lot of energy and a lot of administrative paper pushing. The payroll companies are running separate applications for under 100 and less than 100. Remember, if you're filling out the full application, you have to split out the over 100 to less than 100. And that includes anybody who received any single pay over 100 for one particular period during the 24-week period. So they could have received a bonus and they maybe are being paid $50,000 in pay for the year. They get listed as over 100. So as you run these lists and you see employees that look not to be over 100, they belong there because that's the way the rules work. On the non-payroll cost timing, just going through, remember that if you pick an alternative payroll period, which is basically what that is, you could pick as the date of the funding, you could pick the first pay date, and the days before the funding count, or you could pick the first pay period that starts after funding and wait until that's paid and pick the 24 weeks after that. If you picked alternative pay period, you can't do that for non-payroll costs. It starts the date of funding. It's during the 24 weeks after the date of funding if you're using non-payroll costs at all. So just be aware of that and just be cognizant of that. Chris, if you can move to the next slide. On interest, remember that if you are including non-payroll costs, it has to be secured in debt. It cannot be unsecured debt. It could be on real or personal property. So if you have a very personal property intensive business, this could be very, very helpful. And you have to, again, on any sort of, you could refinance mortgage or they're eligible, but you have to make sure you show that the original mortgage existed before 2/15. The other thing I'll say is just be ready. There's a lot of applications that are going to start coming in the next month or two. And this leads into the tax situations and the political environment, which I'm going to spend one more minute on here. With the current election that just happened, if there's going to be a Georgia runoff with 2 senators, because right now you have a 50 to 48 sort of Republican Democrat Senate. If the two Democrats win the runoff, you're going to have rising tax rates. Crystal ball, if I were to make a crystal ball prediction, probably 90% chance or more one of those Republicans are going to win and the Senate's going to be controlled by Republicans. But it's possible it's controlled by Democrats. If it is, tax rates are going to go up significantly, not by a small amount. The proposals were, I think, around 23 cents on the dollar for clients making over $400,000 in an LLC. So the question then behooves is, should we apply for loan forgiveness now or should we apply for it later? The only downside I would say of applying now would be is if a Republican is elected in Georgia, then and the rates don't change because nothing can be changed, then potentially depending on when there is forgiveness, the IRS hasn't said anything about this, you may be able to delay taxation for a potential year. What we are telling our clients in our firm is to probably apply now because you're going to pay the tax anyway, potentially. You may risk having higher tax rates. In addition, you don't know what a Biden administration may say on loans. They may say some of these PPP loans need to be returned. Nobody knows. So the unpredictability, if you have that letter in your hand saying it's forgiven, it's over, you would hope that you can move forward. For under $2 million loans, they said they weren't auditing it. So hopefully that's completely over. For over $2 million loans, the process, who knows how that process is going to work with and that's what Karen's going to talk about, which is very concerning with some of the questions that they're going to ask. And I think that's a great segue into Karen talking about the over 2 million.
Okay, thanks, Ken. So, right, we can go right to that, Chris. All right, so I'm going to start anyway with, like Ken mentioned, new developments for for borrowers that have received more than $2 million, $2 million or more in their loans, in their PPP loans. So the SBA recently released a draft of a questionnaire that borrowers will be required to complete if they have received PPP loans of $2 million or more. Now, it's of note that the SBA has not yet released the forms publicly. They've issued drafts to the lenders, and it's estimated that the questionnaire will apply to approximately 30,000 borrowers. Now, the questionnaire verifies good faith certification made by borrowers that current economic uncertainty made the loans necessary to support ongoing business operations. Now, you may recall that this was a checkbox on the original loan applications, and now the SBA is looking for their large borrowers to put a little teeth behind their assertion. Now, I think it will be important for borrowers to include in the questionnaire responses the state of mind and the uncertainty surrounding the early days of this pandemic when those loans were being applied for. The length and the magnitude of the business downturns were unknown at that time, and all of that will be important to communicate with this form. Okay, so the questionnaire is reportedly 9 pages long with 21 questions, some of which are multi-part. The questionnaire will need to be completed and returned to lenders within 10 business days. Now, non-compliance with the questionnaire can result in the SBA seeking repayment of the loan. So due to the short turnaround time, and as well as the voluminous nature of it, it's advisable to begin preparations for the questionnaire now. How can we do that? Well, you can start to formulate your thoughts and ideas around your personal current economic uncertainty that you were experiencing at the time of your loan. And you can start to compile the documentation that's going to be needed, and we'll go through that next. Chris, can you go to the next slide? Thank you. Okay, so the documentation that's going to be needed to go along with the questionnaire. I'm just going to go through this as it's on the slide. The borrower's 2020 second quarter revenue relative to previous quarters, whether the borrower's operations were shut down or significantly altered by a government order due to COVID-19, whether the borrower began any new capital improvement projects unrelated to COVID-19 between March 13, 2020 and the end of its covered period. Next slide, Chris. The borrower's cash position on the last day of the calendar quarter that immediately preceded the date of their loan application, whether the borrower made any dividend or other capital payments to its owners apart from their tax distributions, whether the borrower made any prepayments on its debts between March 13, 2020 and the end of its covered period, and whether any of the borrower's employees were compensated in an amount that exceeded $250,000 on an annualized basis during the covered period. So all of these things, again, I would highly recommend that if you're going to fall into this category or your clients fall into this category, that we start getting things together, because there's not a lot of turnaround time once these questionnaires are released, and they're going to come from the lenders. So they won't come from the SBA. They're going to come from the lender to the borrower. Okay.
Yeah, I'll just add something on this. Not only should you get ready with the documentation, but you should probably talk to the best writer you have in your organization, or an attorney or your accountant, because there's a lot of areas in the application that have 1,000-word descriptions that you can add to describe what's going on. For example, you have a partnership, right? Partners take their normal draws, and it asks for what sort of distributions as a partner you took during the period. Well, they're all distributions, and besides tax distributions, which they allow you to exclude, you could have a partnership that has 20 partners and the distributions look higher than the loan amount, which then they're going to say, well, you had no necessity to take the loan. Well, geez, I have to pay my 20 partners to actually live. So, it's one of those things where you're dealing with bureaucrats, you're dealing with people at the SBA who may not understand what's going on in your business. And it's very important where it says required documentation that when you attach the documentation, you put memos on top of that. When you have the 1,000-word questions, you should craft those questions to clearly describe what the situation is. Because the situation may look to a government official with $2 million in cash and you took a $2 million loan. Well, how can you take a loan? You had plenty of liquidity. Well, if I didn't take a loan, I have 200 employees. Within 4 weeks or 3.5 weeks, I'd have zero liquidity. So you need to describe those types of things to the SBA. Otherwise, you could find them denying your loan. So it's really, really important to get that area in the memos really put together. Since you only have 10 days, Karen stated it best, start doing it now.
Yep. Okay. Thanks. Next slide, please, Chris. Okay, next I just want to touch briefly on a development that came out of the District of Columbia. Recently, the Federal District Court in the District of Columbia ruled that all Small Business Administration, PPP, and EIDL loans are subject to the Freedom of Information Act and therefore considered public information. The judge ordered the SBA to disclose the names and addresses of borrowers along with their loan amounts to a coalition of news organizations that had filed a request under the Freedom of Information Act. Previously, the SBA had tried to protect the names and addresses of the borrowers as well as their loan amounts, citing confidential payroll information that the loans are based on. The court rejected the SBA's argument based on the fact that the borrowers had been warned upon application that the information would be made public under the Freedom of Information Act. So that just may be noteworthy to some of your clients as well. And at this point, I think I'll pass it back to Chris, and I think we're going to have Q&A.
All right. So there's the frequently asked questions. And just to remind everybody, if you have a question, put it into the chat box. If you don't want to send it to everybody, you can send it to me privately, and I'll keep your name anonymous. So to get to the first question, this is the one that came up while Ken was speaking. I have a client that got the loan in June, but he started payroll in October. Can I use the 24-month and file by 12/31/20?
Let me unmute.
Ken,
Can you repeat that question again? I'm sorry. I didn't hear you.
Yeah. Okay. So I have a client that got. Wait, am I on mute? Can you hear me? Okay.
Yep, I can hear you.
Okay. I have a client that got the loan in June, but he started payroll in October. Can I use the 24-month and file by 12/31/20?
It's 24 weeks, but yeah, I mean, if they got the loan and then they didn't have payroll, the 24 weeks starts when the loan was received, and you could use 24 weeks after the date of basically funding, or you could use an alternative method that starts the payroll a little bit later. So you could definitely, and you could file within 10 months after the 24-week period ends. So you could file up to August of pretty much 2021, around about on average for most clients. So yeah, you can include that stuff, but it depends how much payroll you have during the 24-week period, and you may not have much if it started in October.
Okay. And then the next question, 10 days to complete the questionnaire. Can you clarify when this count starts? This is for the questionnaire.
Yeah.
10 days to complete the, can you clarify when the count starts?
It starts on the date you received the questionnaire from the lender. That's what it says on the application, on the questionnaire. Whatever that means, that's what it means. I guess date of receipt is the date you actually physically receive it by email or whatever forms of communication that you receive it.
Okay, great. Next question. If an employee was terminated around 2020, position eliminated, unrelated to COVID-19, will this negatively impact the FTE calculation?
They're terminated 2/2020. Well, that's pre-funding of the actual amounts. It might affect your look back period because your second look back period is 1/1 to 2/29. It's averaged out, so it's going to have a very minimum effect on how much your full-time equivalents are, but it will have a small effect on it.
Okay. Next question. Any consensus yet on how to report loan forgiveness on financial statements?
Yes, I have an answer for that. Our head of A&A basically says that international accounting standards are taking different positions than US GAAP. US GAAP, I believe, and someone could correct me if I'm wrong here, I believe what head of A&A said is you keep it as a loan until forgiven, but on international accounting reporting standards, they're treating it as a non-loan at the end of the year, basically as income. So I think you have to look at ISASB, and I'm not as much of a GAAP person. I kind of keep in touch with what's going on, and you have to look at US GAAP depending on how you're reporting it. They like everything, they differ in opinion on absolutely everything. So
I can just add to that, and you also need to be accruing interest on that loan. So if it's forgiven, then you'll reverse it at that time. But in the interim, the loan should be in the liability, and you should have accrued interest on it.
Okay, great. Okay, next one. Can the loan forgiveness app be signed by a third party? Well, I guess the broader question: who signs the loan forgiveness app? So this one might be one for Shri.
Yeah, so good question, Scott. So the loan forgiveness app needs to be signed by the same person that signed the loan application for the PPP to begin with. And more than likely, it's the owner that did that.
Okay, good. Okay, next question. The look back period question. It's a look back period question. If the pay periods or pay dates are between 2/15/19 to 6/30/19 or 1/1/20 to 1/29/20. So are you looking at the pay period between those two dates? So there's the follow up back to.
I believe you generally look at the pay dates that fall in between those periods. That's generally the way it's working, not the actual dates itself. So any pay date that falls within that period, you look at all those pay dates, you add them all up, you average them all out, and you figure out your FTE. But most of the payroll companies have customized reports that you just click the button and it does it for it out of the payroll system, which makes it very, very easy.
All right, good. And then the next one that just came in, based on your experience, this is for the whole panel, based on your experience for loans over $2 million through today, what is the rate of forgiveness? Have you seen any of these forgiven for any loans over $2 million yet? Zero. So, I guess they're all taking the wait and see. Okay. Any additional questions? One just came through. If the payroll is done in-house or payroll reports are sufficient, if payroll is done in-house, are payroll reports sufficient, or you need to attach bank statements as well? I guess the bank statement to show in the payroll, the payroll amounts. So if you do your payroll in-house, what do you provide to the bank?
So I can take a stab at that first, and then maybe Karen, if you have anything to add. So yeah, I mean, payroll reports are basically supplementary information that you're providing, but you do need to support it, showing that it was an expense that was made. So you just need to add the bank statements showing that the money actually got paid. So that either could be bank statements or it could be the payroll report itself, the tax filing that you do for the quarter.
Very good. Okay, next question. The cover period, actually just one housekeeping note. Some people have a hard stop at 9. We're now at 8:53. I have the screen with everyone's contact information. So if we don't get to your question, please take a screenshot or of the panelists. And one other thing to note is the PowerPoint, I believe, is saved on the website. So if you go onto the the page for the event, you can pull down the slides. So next question, the cover period on form 3508 is explained as 8 weeks. Can you use the 24-week period instead?
Yes. They had to update
Yep.
those instructions, but that you could use 24 weeks.
Okay. Many people are waiting, saying to wait for to apply for loan forgiveness. Just to be clear, are you saying to apply now, if able to?
I'm not saying what you should do. What I'm saying is that you have to look at everything in life with upsides and downsides. The upside of applying now is the banks, and Sri could say this, are not as busy yet. So your application will go through quicker. If you're under 2 million, within 7 to 10 days, it's been approved. The downside potentially could be that the approval letter gets received in 2020, and that's the way they show that expenses must be added back on the amount you received based on the date of the letter of approval. I'm not sure. Nobody has an answer. The IRS might even still backdate it and say that since you spent the money in that year, if you're forgiven before you file your taxes, you still have to report it in that year. So also the downside of not applying now potentially is if tax rates go up, then you're going to be paying a higher tax on if you receive a letter in the next year. And that's the way it works. The date of forgiveness letter is the date that you have to report those expenses back to income. If the tax rates are 20% higher, it's going to be quite a penalty for not applying this year compared to, next year. So you got to weigh all those factors, determine what's best for you. I could tell you the majority of our clients have decided to file now. There's a couple that want to wait, and that's their prerogative, and we're not convincing them either way. But as advisors, when you're advising your clients, if you're telling them file next year and then all of a sudden they're hit with a 20% additional bill, guess who they're going to come back and sue? They're going to sue all their accountant who advised them to file the next year. So you just have to tell your clients all the factors and let them make their own decision.
It's really an
Great.
individualized decision because, like Ken said, everybody has a different set of circumstances. You really have to consider the different factors that pertain to you. For some people, there's the FTE calculation and the wages calculation. And if you're in that realm, you may need to wait till December 31st if you need to fix your numbers. If not, you might want to do it now. So there's a lot of different factors involved.
Great. And this one probably we'll have enough time to answer this last question here. All right. So if the loan is forgiven, is it considered income?
The loan is not income. The loan portion is non-taxable. That's what was originally said when the law was passed. The expenses related to the loan are non-deductible. So those expenses all have to be added back. The question is the timing of the expenses, whether they have to be added back in 2020 or 2021. The IRS has not answered that question. It might depend on the date of the forgiveness letter. It might be backdated to 2020 to match the non-reporting of income against expenses. Congress might put a patch in 2021 if they could agree on things saying it's not taxable at all. So that's still a possibility as well.
There's a lot of speculation that will happen. That's a lot of my clients are waiting. hoping that they're gonna, put that patch in.
Yeah, people can wait, but it's not going to make a difference filing for your application now because you're not reporting your taxes until April 15th of 2021 anyway. So if they make a patch and change it and say that's not taxable, you could fix that, for your tax return reporting.
Right.
I think a lot of people should go on extension potentially if it's not settled by April 15th.
Okay. And then the last question, which is a follow-on question to that, is what about the issue that New Jersey doesn't recognize COD income? Will both income and expenses be excluded in New Jersey? Or will New Jersey income be lower by the PPP loan amount?
Okay. So in New Jersey, definitively, the income portion is not taxable. There is some literature saying potentially expenses are not going to be allowed to be deductible as well. I think, we're going to have to look into that a little bit further. I'm kind of just waiting and seeing on that, but I can tell you definitively the income is not taxable in New Jersey.
Okay, well, great. So thank you to all our panelists, Karen, Ken, Shri, and just to throw it out there, this forum meets every month, the second Thursday every month, 8 a.m. So look for the event on the events page on the NJCPA. And thanks for everyone for participating and attending. And hopefully we see you next month. Have a great day, everybody.
Okay.
Great job. Thanks, Chris.
Thanks, everybody.